If you've spent any time at all trading,
Yeah.
you know the feeling, right? You pour hours into charts, systems looking for that magic indicator.
Yeah.
But despite all that effort, it often just leads to frustration, not profit. So what if the biggest factor isn't the system, but, well, what if it's you?
That's exactly what we're going to dive into today. So many traders struggle with consistency, and it's usually not the market itself. The real hurdles are often internal, psychological. Understanding your part in all this, why you react the way you do, that's really the first step towards, consistent profitability. Our mission here is to unpack those internal dynamics.
Yeah, I hear this constantly. People know the theory, they can read the news, spot patterns, but they just can't seem to make it work consistently. It's like a disconnect.
Totally.
And what we're saying is this lack of consistency, it isn't really about your software or some guru newsletter or even getting your indicator settings wrong.
Nope. It's simpler and maybe harder than that. That lack of consistency, it's really down to one thing, you. I mean, the mechanics, buy, sell, do nothing. They seem simple, but getting consistently profitable, that's tough because it just shines a spotlight on your own weaknesses, your frailties.
That's a great point.
Think of your trading mind like a muscle. You got to nurture it, work it out daily. Even really experienced traders, people who've done this for years, they're still battling those internal struggles. It's ongoing.
That muscle analogy really hits home. It's not a quick fix, it's a continuous thing. So if we accept that we are often the biggest problem, how does understanding the why become more important than just the how?
Oh, it's absolutely crucial. Think about other big challenges people overcome, like, say, addictions. We looked at some really compelling stories about people beating nicotine, alcohol, and those stories, they aren't directly about trading, obviously, but they show this universal thing. Real success in changing deep patterns comes when you understand the nature of the trap. It's not just about willpower.
Right, you need to know why you're stuck.
Exactly. And it's the same in trading. You definitely need to understand the markets, sure, which are basically just collective human psychology anyway. But even more vital is understanding what makes me do what I do.
Yeah.
That helps you tackle those nagging questions. Why am I not profitable? Why do I freak out when I'm trading? Why do I plan one thing and do the total opposite? And maybe the biggest one, why am I not acting in my own best interests?
That completely reframes it. It's not just external forces, it's our own brains, which are designed to keep us safe and avoid pain, actually working against us in trading.
Precisely. And this is where the work in behavioral economics, particularly from researchers like Daniel Kahneman, becomes so relevant.
Yeah, prospect theory, right?
Exactly, prospect theory. It shows how our built-in biases mess with our decisions. Let's take an example, okay? 2 scenarios.
Okay.
Scenario 1. A trader loses, say, 5,000 pounds, market swings wildly, but they trade well and make it all back by day's end. Break even. They rate the emotional intensity maybe as 60 out of 100.
Okay. Stressful but recovered.
Right. Scenario 2. Different trader, great morning, makes 20,000 pounds. Fantastic. But then the market turns, they lose it all by the afternoon. Also break even. That person rates their emotional intensity a 90.
Wow. Same outcome, 0 profit loss,
Yeah.
but way more intense emotion.
Way more. It shows people feel much more strongly about losing gains they already had than they do about just recovering losses to get back to 0.
So it's the psychological past, not just the end result. That's fascinating.
It really is. And that's a cornerstone of prospect theory.
Yeah.
Our decisions aren't purely rational. They're shaped by how we perceive risk. And a key finding is that losses are twice as powerful psychologically as gains. Loss aversion.
Right.
Think about how things are framed. You say a drug will kill 10 out of 100, people react negatively. You say the same drug will save 90 out of 100, people react positively. Same data, different feeling.
Or like 5% fat versus 95% lean meat.
Exactly. Our brains latch onto the framing. So if our default is minimizing pain, how does that mess us up in trading?
Well, I guess it drives behaviors that feel safe short-term but hurt us long-term.
You got it. Look at risk. Offer someone a sure 100-pound win versus a 50-50 shot at 10-pound or 200 pounds. Almost everyone, like 95%, takes the sure 100 pounds. We're risk-averse for gains.
Makes sense. Lock it in.
But flip it. Offer a sure 100-pound loss versus a 50-50 shot at losing 10 pounds or 200 pounds. Now, 95% take the gamble. They become risk-seeking to avoid that certain pain.
Ah, okay. I see where this is going for trading.
Right, we're wired to dodge pain. So in trading, that means snatching profits too quickly, gotta lock in the gain, avoid the pain of it slipping away,
Hmm.
and conversely, holding on to losing trades way too long, hoping, praying they'll turn around because actually booking that loss feels incredibly painful.
That sounds like a recipe for disaster. And it explains why so many new traders get obsessed with their hit rate, their win percentage. That seems like a really bad focus now.
It's one of the biggest traps. Comes from that fear of being wrong. Let me give you a couple of real examples. We had this trader, Christian, consistently profitable, but get this, he lost more often than he won. 53% losers in the DAX, 55% in the Eurodollar.
Wait, more losing trades, but he made money. How?
Yeah, nearly £12,000 in a month. The key. He consistently stayed with his winners much, much longer than his losers. He let profits run.
That's completely the opposite of what you'd instinctively think.
Now, compare him to Kevin. Extreme case, but useful. Kevin had an unbelievable 95% win rate. 95%.
Wow. Okay, he must have been rolling at it.
You'd think so, right? He lost over £42,000.
What? How on earth is that possible with a 95% win rate? What was he doing?
It was bizarre. When a trade went against him, he wouldn't close it. No, he'd open a hedge position on a second chart of the same thing.
A hedge, so going the opposite way.
Yeah, basically neutralizing it temporarily. He only closed trades when they showed a profit. So he'd close the profitable side of the hedge, but keep the original losing trade open, sometimes for days, just hoping it would come back.
Oh my goodness.
His average winning trade was closed in about 99 minutes. His average losing trade held for almost 5,400 minutes. That's like nearly 4 days.
So he just absolutely refused to accept being wrong. The pain avoidance was extreme.
Totally. It completely wrecked him financially. He was driven by this desperate need to be right, not to make money. His story is the perfect, painful illustration that the goal is profit, not a high score.
That's dark.
And while Kevin's extreme, that underlying fear, it's common. It just shows that most traders really need to work on their fear response, their mindset, maybe more than their actual trading technique.
So it really is this paradox. Traders are fearful when they should be hopeful in winners and hopeful when they should be fearful in losers. You called it the disposition effect.
That's the one, the disposition effect. It's this irrational tendency we have to lock in, gain sell winners, get that quick hit of euphoria, but being much less willing to recognize losses, holding on to losers to avoid the pain.
Even though it's totally irrational, the market doesn't care what price you bought at. And selling losers might even save you on taxes.
Exactly. It flies in the face of logic. But think about other hard things like losing weight. You accept short-term discipline, maybe some discomfort, for the long-term gain.
Right. Or studying for exams. Pain now, reward later.
Same principle. Trading demands you handle emotional pain. It's like you have these two brains fighting. Your conscious brain wants profit, follows the plan, but your subconscious, its job is just to protect you from pain.
And it sabotages the plan.
Constantly. It's the voice whispering, don't use a stop loss. That just proves you're wrong, shows you the loss.
That explains so much as those internal arguments. What are some other common ones that subconscious brain throws out?
Oh, they're classics. Like, don't close it. Look, there's a double bottom forming. It has to hold here. Or this market can't possibly go lower. It's fallen so much already. Maybe buy more, average down.
Yeah, heard those before.
Or even, just close it here. You can make back this small loss on the next trade easily. Anything to avoid the immediate sting of being wrong or booking the loss right now.
And this internal battle, this conflict that leads straight to cognitive dissonance, right? That stress when your actions don't match your beliefs. How does that play out day to day for a trader?
Oh, it's everywhere. Often really subtle. Think about that real estate broker, John. Super sharp guy, reads the charts, genuinely believes the market's going higher.
But doesn't profit from it.
Right. And the excuses come out. Oh, I was out, had a meeting. But it's not just excuses, it's the dissonance. He believes it'll go up, but the subconscious fear of being wrong, the potential pain of a loss, it's stronger. It stops him from actually acting on his own analysis.
Wow. So it paralyzes him.
Pretty much. And that's why great trading requires something, well, extraordinary. It demands the ability to change your mind, face discomfort, and actually act against those powerful natural instincts.
So if instinct is often the enemy, what separates the truly great traders? Let's talk about that trader you mentioned, the one considered among the best. What's their approach?
Okay, this particular trader operates with incredible discipline. First off, they absolutely refuse to guess tops or bottoms. If they're long, they accept they won't sell the exact high. If short, they won't cover at the exact low. No guessing.
They just accept imperfection and timing.
Exactly. Second, they almost welcome discomfort. They expect it to feel painful or uncomfortable to stay in a winning trade and let it run properly. If it feels too easy, they figure they haven't pushed it far enough.
That's a mindset shift, not seeking comfort, but embracing the challenge. What about getting out? Gut feel.
No, very rule-based. They'll exit if a lot of profit has evaporated or maybe if the market's closing. Otherwise, they stay put unless there's a clear reason to get out. They ask that key question. If I weren't already long, would I go long right now? If the answer's no, they're out.
That's a great filter.
Yeah.
Logical.
Yeah. And third, they're fast movers. They know when they're wrong and pivot quickly. No ego involved, just wrong, change direction. Fourth, it's this interesting mix. Detached curiosity meets aggression.
Curiosity and aggression. How does that work?
The curiosity makes them want to see just how far a move can go. The aggression gives them the nerve to stay in and find out. For them, it's less about indicators and more about reading the market's mood, that collective behavior.
Fascinating. A very disciplined, almost detached approach. Now, let's get the broker's view. We heard from a London brokerage owner. Do they see big differences between the retail folks and the pros?
It was quite revealing, actually. He said, surprisingly, pros and retail traders share many of the same flaws. The big differences. Pros usually have much deeper pockets, they can withstand bigger hits, and crucially, they often have someone watching over them.
Ah, that accountability factor. Makes sense. Harder to cheat when the boss is watching.
Exactly. That external discipline matters.
Right.
What else did he see in retail? A huge over-reliance on technical analysis, almost treating it as the only thing.
Like chart patterns are everything.
Yeah, often missing the bigger picture, like economic news driving shifts. He said retail are notoriously slow at changing trade direction when the underlying trend changes. And they tend to trade the same size all the time, regardless of volatility. Big mistake. You should scale down when things get choppy.
Good advice.
And probably the biggest one. Retail traders hate buying strength, but they love buying weakness. And the opposite for selling, always trying to pick tops and bottoms.
Fighting the trend.
Constantly, which leads to just bleeding their account slowly through 1,000 cuts, with tiny stop losses getting hit over and over.
So they're trying to be heroes instead of just going with the flow. What about the idea that brokers want clients to lose? Any truth to that?
Absolutely not, according to this breaker. It makes no sense. If clients blow up their accounts, they stop trading. Lost client. Brokers want clients to win because winners trade more, stay longer. That's why they offer tools and education. It's in their interest for you to succeed.
Okay, good to clear that up. Now, building on that technical analysis point, many traders live and breathe chart patterns. But you're suggesting maybe we shouldn't put all our faith in them.
Yeah, we need to be really careful. Take the doji candlestick. Everyone learns it means indecision. Maybe a reversal is coming.
Right, classic pattern.
But someone actually did the stats on, say, a fast 2-minute DAX chart. They found tons of dojis in a day, maybe 38 or so. But how many led to a real reversal? Only a few. Most were just pauses before the trend continued.
So on short time frames, it's mostly noise.
Exactly. There's this big inverse correlation between the time frame and the signal strength. Quick signals are often just blips, and it's not just dojis. Another researcher looked at loads of Japanese candlestick patterns. Conclusion: none was statistically significant.
Wow, none.
None. He talked about validity bias. We think we're much better at spotting real patterns than we actually are. Our brains love finding patterns, even in randomness.
Like seeing faces in clouds.
Kind of. Plus, just changing the time frame settings on your chart can make it show completely different faces. So relying solely on specific patterns is shaky. Trading is much more than just patterns and moving averages. It's about understanding what's really driving things.
That really puts technical analysis in perspective. It's a tool, not a magic wand. Which brings us back to the stop loss, the critical but often hated tool. Why is it so hard for traders to just use them consistently?
It goes back to that core issue. We grab profits fast, but cling to losers. Why avoid the stop? Deep down, it's because we hate being confronted with the reality that I am proven wrong.
The ego again.
The ego and the sheer pain of booking that loss. Staking money and ego on a trade makes losing really hurt. The sad truth is, many clients win 9 times out of 10, but the 10th trade loses them more than all the 9 others put together. This whole deep dive is about learning to be the 1% who avoids that fate.
And what are those internal voices saying to talk you out of using a stop?
Oh, the usual suspects. My account's big enough I can take the hit, or I just know I'm right on this one, don't need a stop. Very common. The stop will just get triggered by noise, then I'll go my way anyway.
The classic stop-run fear.
Exactly. Or Got to give the market room to breathe. But often, the real unspoken reason is just, I don't want the system showing me exactly how much I could lose. I don't want to face that number.
So much mental gymnastics to avoid facing reality.
Yeah!
Okay, so once you do commit to using stops, how do you place them properly, not just randomly?
Definitely not random. It needs logic. Place it somewhere that makes sense on the chart, maybe just beyond a recent high or low. Consider the size of the last swing. Markets often move in similar waves.
Okay.
Major Fibonacci levels can be useful guides too. But really critically, you need to factor in average true range, or ATR.
DPR, volatility measure.
Exactly.
Yeah.
It tells you how much the market's typically moving, its noise level. You set your stop based on a multiple of ATR, so it adjusts automatically.
Right.
Wider stop in wild markets, tighter in quiet ones. This stops you getting knocked out by random jiggles before the real move happens.
So the stop adapts to the market's current personality. That makes sense. Beyond the where, what's the psychological advice for actually using stops without freaking out?
Two key things, really, both about detachment. One, seriously consider trading smaller. Less money on the line often means less emotional turmoil while you get this stuff handled.
Lower the stakes.
Right. Two, place the trade, place the stop, and then walk away. Seriously, step back, detach, remind yourself over and over. It's just one trade out of thousands. Don't let this trade be your last because you couldn't handle the potential pain. It's not your whole future.
It's just one of many trades.
Yeah.
That's a good mantra. Okay, so it seems like the struggle is both taking losses and letting winners run, which is the bigger problem usually. And what does it tell us about why someone's really trading?
That's maybe the deepest question. I remember talking to this one trader, really honest guy, admitted that, yeah, he thought he traded for money, but really he traded for peace, for mental equilibrium.
How does that work?
Meaning the feeling of getting back to break even after a loss. That feeling was more rewarding subconsciously than actually making a big profit. And this leads to that destructive pattern. Position size goes up when you were losing and down when you were winning.
Ugh. Chasing losses with bigger bets, but getting timid when winning.
Exactly. That's trading your P&L. Your decisions are driven by your current balance, your emotional state, not the objective market.
Trading your feelings, not the chart.
Precisely. And the really powerful, maybe confronting takeaway here is this. You tend to get what you really want from the markets. If you genuinely want profits and you've done the hard internal work, you often get profits.
Right.
But if you think you want profits, but deep down you actually want something else, excitement, drama, adrenaline, maybe just avoiding boredom, or the random reward buzz, you'll probably get that instead. The market just gives you what you're truly seeking, examined or not.
Wow.
Yeah.
It's a lot to think about. The market reflects your subconscious desires. Okay, so pulling all this together, all these psychological insights, what's the distilled market wisdom? The key principles for someone trying to make that shift?
Okay, let's boil it down. First, focus. Pick one or two techniques that really click for you and stop chasing every new shiny object.
Stick with something.
Yeah. Second, accept missed trades. Your system won't catch everything. Ignore the what-ifs from other systems. Third, remember, it's very expensive to try to convince the markets you are right. Don't argue with the tape.
Cut the ego.
Definitely. Fourth, the absolute core of good trading. Cutting losses, cutting losses, cutting losses. Cannot stress that enough. Fifth, remember, losing a position is aggravating, whereas losing your nerve is devastating. Keep your cool.
Important distinction.
Sixth, blunt truth. If you can't take a small loss, sooner or later you will take the mother of all losses. Seventh, manage your size. Risk enough so a win feels meaningful, keeps you focused, but never ever more than you can truly afford to lose. And interestingly, sometimes trading too small makes you sloppy.
Find that sweet spot. What about trade setup?
Ideal flow. First trend, then pattern, then a good spot to execute. Trend first. Eighth, back to that earlier point. Win or lose, everybody gets what they want out of the market. What do you really want? Ninth, don't obsess over fundamentals you read in the news. They're often already priced in, fundamentals, as some say.
Market's already moved on.
Usually. 10th, money management is your survival kit. It's the rational shield against your own biases. 11th, the market's like the ocean. Don't fight the tide. The market is always right. And finally, that well-placed stop order. It answers one simple question. At what price is your opinion wrong?
That's a perfect way to frame the stop loss. Clear and objective.
At the end of the day, successful trading, well, it's neither hard to trade well nor is it easy. It just is. The real strength isn't in finding some secret pattern. It's in understanding the nature of the trap, your own psychology, and then consistently doing the things you've learned you need to do, even when they feel weird or uncomfortable at first. It's about consciously rewiring how you react to risk and reward.
So given all this, given how our minds naturally work against us in this arena, if consistent profit means acting against instinct, here's the question for you listening. What is your single biggest internal barrier holding you back from consistent trading success? And maybe more importantly, what's one courageous step, just one you can take today to start tackling it?